Welcome to the deep dive. Today we're really digging into a pretty rare breed of stock, the ultra high growth or UHG companies.
Mm.
Our mission really is to try and decode the fundamental DNA of these firms.
Mm.
The ones that don't just beat the market, they generate, truly astronomical, life-changing returns.
And astronomical is the right word. We're talking about a very exclusive club here. I mean, just look at the last decade. You've got NVIDIA up, what, 31,000%? AMD 6,900%.
Hmm.
These aren't just winners, they changed the whole game.
Wow. Yeah.
And the common thread, it's sustained strong double-digit revenue growth,
Yeah.
consistently hitting 20, 30, maybe even 40% plus on the top line, year after year for like a decade sometimes.
So it's not just one good year, it's that compounding effect, that acceleration that makes a market sit up and take notice.
Absolutely. And you often see a clear uh, inflection point. Think about Palantir. It was kind of grinding along, maybe 12% annual revenue growth. Market wasn't too excited. Then, boom, growth shoots up to 48% in a single quarter. That drastic shift, it led to gains over 2,000% because the market suddenly had to rethink its entire future value.
Okay, that's the massive upside.
Yeah.
But we have to start with the warning, right? The non-negotiable part.
Yes, this is crucial. If you want those exponential returns, you absolutely must accept potentially life-altering volatility. It's gut-wrenching sometimes. This extreme volatility, it's just the price of admission. We're not talking little 5% dips either.
No.
We mean watching these stocks crash 20, 30, 40, maybe even 50%, sometimes within a single quarter, off one piece of news. It's really a psychological stress test, It shakes out anyone who doesn't have total conviction.
And that panic often comes from the valuation itself, doesn't it?
Right.
These UHG stocks, they always seem to trade at really high PE ratios, high price to sales. By all the usual metrics, they just look expensive. So how do you justify jumping in when it seems like it's already run up so much?
You've got to shift your mindset. Think exponential, not linear. It's like the F1 car versus the Honda Civic analogy.
Yeah.
Your Honda Civic, that's your average stock. Predictable, stable, maybe a bit cheap. Priced on what it does now, you pay a fair price, you get a predictable ride.
Right, good for steady compounding, maybe, but not explosive growth.
Exactly. The UHG stocks, they're the F1 cars, engineered for insane performance, built to take corners at speeds other cars can't even dream of. They cost more because you aren't paying for today's net income. You're paying for the compounding effect of that rapid future growth.
So the deal is basically the company has to execute flawlessly. They have to grow into that sky-high valuation over time.
Precisely. If they actually hit that 30% plus revenue growth target for 5 years straight, then all those future cash flows, when discounted back, justify today's high price. If they deliver the price you pay today, it'll look dirt cheap 5 years down the road. That's the conviction you need to weather the storms.
Okay, let's put that thinking to work. Our first case study, Celsius Holdings. Over 700% return in 5 years. A real poster child for both the gains and that volatility test we mentioned.
Oh, Celsius is a classic. They started smart, targeting a niche, the fitness and gym crowd, setting themselves apart from those sugary legacy energy drinks. Then they broadened their appeal, acquiring brands like Alani, which really resonated with female consumers.
But the real kicker, the massive acceleration, that came from partnering with Pepsi, right? Why was that so vital for Celsius?
Because they were hitting a wall against the Monster Red Bull duopoly, building a global distribution network from scratch. It's incredibly expensive, takes decades. Celsius couldn't do it alone. Meanwhile, Pepsi needed a winner in energy drinks. Their Rockstar acquisition hadn't really panned out against the big two.
Ah, so perfect match. Pepsi gets a hot, modern brand. Celsius gets instant, massive distribution. What does that Pepsi muscle actually mean on the ground, like in the supermarket?
It's night and day. Suddenly, you're not fighting store by store for a tiny bit of shelf space. You get prime placement everywhere. Every major supermarket, gas station, convenience store. Pepsi handles the logistics, ensures it's everywhere. That drives huge sales volume. It's the exact same playbook Coca-Cola used with Monster Energy years ago. You just can't build that reach independently in this space.
But talking about volatility, Celsius had a really rough patch in 2023. That big dip was tied to the Pepsi logistics, wasn't it?
It was a real test of faith for investors. Pepsi got a bit over-enthusiastic initially, over-ordering, inventory issues.
Right.
It wasn't collapsing demand, just messy supply chain stuff getting sorted out. Revenue dropped 30% at one point. I know people who panicked and sold right then. But look at the latest quarter, 83% revenue growth. That signals the system's calibrated now. The Pepsi machine is firing on all cylinders again.
Okay, so they've grabbed a lot of U.S. share. Where's the next big growth spurt coming from? The F1 level grows for the next 5 years.
International. Almost entirely. That's the main story for the next decade. It perfectly mirrors Monster's path. If Celsius executes well globally, well, those 700% gains might just be the beginning.
Fascinating. So if Celsius won with logistics, let's shift to ELF beauty. Here, the growth battle seems to be literally about inches of shelf space. Another big winner, 551% return, also known for wild swings. What's driving ELF?
Two main things: affordability and speed. Most of their stuff is under $15. That clicks with younger consumers who follow trends closely. And their edge is social media savvy. They spot a TikTok trend, formulate a product, and boom, it's on shelves way faster than giants like Estee Lauder or L'Oreal can manage. That speed is key.
You mentioned shelf space. They're already in big places like Target, Walmart. How can they still be under-distributed?
Because the products fly off the shelf so fast, their sales velocity is incredibly high. Retailers see that data. The demand for ELF is basically forcing retailers to give them more space, literally taking square footage away from competitors. ELF's numbers dictate the shelf allocation.
And a recent boost came from acquiring Rhode, Hailey Bieber's brand. That created a lot of noise.
Oh, yeah. The Rode acquisition is a huge catalyst right now. It broke records $15 million in first-day sales when it launched in Sephora North America. That kind of hype, often fueled by calculated scarcity, creates powerful consumer momentum.
Yet, the stocks pulled back recently. A couple of sleepy quarters, growth slowed down to single digits. That volatility is biting again.
It is. And the market seems to be pricing in that slowdown still. But here's the potential UHG angle. Many analysts expect the Rode acquisition to act like a slingshot. They see it driving growth back up to like 40%, 50% clips. The market might be caught flat-footed if that acceleration happens.
So you're saying the potential revenue explosion isn't fully baked into the price yet. What could that mean for the stock price if they're right?
Well, if you model that kind of revenue spike plus their strategy of becoming a multi-brand powerhouse, kind of like Estee Lauder did back in the day, buying up cool high-margin brands, some analysts are projecting it could head towards $200, maybe higher, within, say, the next 9 months or so.
Okay, let's switch gears completely. A giant that maybe doesn't immediately scream UHG because of its sheer size, Meta Platforms. How does a company this massive, growing 21.6% recently, Instagram at 3 billion users, still fit this ultra-high growth profile?
Because the runway for new high-margin revenue is still potentially huge. Meta's a behemoth, yes, but it still acts like a hyper-growth company in many ways. Think about WhatsApp monetization. It's widely seen as being in the very, very early stages. That alone could unlock billions in new profitable revenue streams.
And they're placing this massive bet, $20 billion a quarter, in CapEx capital expenditure on AI infrastructure. That's a staggering amount. Why so aggressive?
Yeah, CapEx is spending on assets, chips, servers, data centers for Meta. Zuckerberg doesn't throw around $20 billion a quarter lightly. He must be incredibly confident that this AI investment will generate multiples of that back in future ad revenue and efficiency gains. It's a foundational bet on staying ahead technologically for the next 5, 10 years.
And his track record kind of backed that up, doesn't it? Buying Instagram for $1 billion, WhatsApp for $19 billion. People thought he was crazy then. He seems to buy foundational pieces that pay off hugely down the line.
He does. And the core engine is still delivering ROI for advertisers. Their AI targeting is just so sophisticated. Whether you're selling direct to consumers or generating B2B leads, advertisers keep flocking to Meta because they get really good measurable results. It's that return on investment that keeps the ad dollars flowing.
Okay, let's try to put some numbers on this vision. We looked at some projections out to 2029, a base case, a bold case, even a bear case. What does the base case look like?
All right, the base case assumes, let's say, a pretty reasonable 15% average annual revenue growth through 2029. You apply a fair PE multiple, maybe in the 29 to 34 range. That gets you a projected stock price somewhere between $1,600 and $1,800. Solid growth, definitely.
And the bold case. If WhatsApp monetization really takes off and their AI models dominate.
Well, if they hit, say, 20% annual revenue growth and the market gives them a higher multiple because of that dominance, maybe 35 to 45 times earnings, then the projection jumps to between $2,200 and $2,800.
Wow, okay, but what if things go wrong? A global recession hits, growth slows way down. The bear case.
Even if you model just 10% average annual growth, which would be pretty slow for them historically, and use a conservative PE, maybe around 23, the stock price projection is still between roughly $960 and $1,200 by 2029. So the key takeaway for the listener is that even in what seems like a plausible worst-case scenario, Meta is still projected to likely beat the overall S&P 500.
All right, final deep dive. The AI chip race, specifically advanced micro devices, AMD. Looking back 5 years, AMD's 75% gain looks, well, kind of weak next to NVIDIA's 1,200%. Feels like they're always chasing.
NVIDIA definitely had a massive head start, no question, but AMD under CEO Lisa Su has made some really smart moves. The Xilinx acquisition was key, and developing the MI300 chip series aimed squarely at AI acceleration. And you're seeing it in the numbers now. Revenue growth just jumped from a pretty sluggish 2% up to 31%. That's the kind of inflection point we look for in UHG.
But the big worry for AMD is still NVIDIA's CUDA software, right? For people not familiar, what makes CUDA such a powerful advantage for NVIDIA?
It's basically proprietary software that AI developers have been using for years. It creates this ecosystem lock-in, moving complex AI models that were built on CUDA over to a different chip maker. It's difficult, expensive, time-consuming, huge switching costs. But AMD is playing the long game here, capitalizing on how the market's changing.
How did they fight back against that CUDA mode then?
Their biggest customers, the hyperscalers, think Google, Microsoft, Meta, they are desperate for supplier diversity. They really don't want to be totally reliant on NVIDIA and their pricing. So AMD is leaning into open source software like ROCm and offering custom chip designs specifically for this massive high profit enterprise market that wants a strong second option.
That's a bold call, though. You're essentially saying most analysts who are projecting maybe 18% to 27% growth for AMD might be wrong. Why bet against the consensus here?
Because those numbers feel, well, potentially too linear for an explosive market like AI compute. Think back, analysts completely underestimated the exponential demand curve for NVIDIA initially. They modeled steady growth when demand was going vertical. I suspect they might be making a similar mistake with AMD. The UHG opportunity here is that potential upside shock, what if AMD starts hitting 40%, maybe even 50% plus growth? That possibility isn't really reflected in current analyst models or the stock price.
That really highlights the potential asymmetry in these UHG plays. Okay, before we wrap up, let's touch on a couple of contrasts. First, Kava, the Mediterranean restaurant chain. Ticks the growth box right, consistently over 20% revenue
That,
growth.
that valuation.
Exactly. Kava's got the UHG revenue growth 38%, 28% recently, strong expansion plans. But it trades at a forward PE of like 111. That's astronomical. You are paying today for years and years of perfect execution, absolute perfection. Any tiny slip up, maybe slightly weaker same-store sales one quarter, the stock could easily get cut in half, crash down to $30 or $40. That's the risk with paying peak F1 prices. Okay, and contrast that with, say, the Cheesecake Factory parent company, also
Yeah.
owns Flower Child.
Cake is much, much safer. Trades at a PE around 12 to 15. It's diversified, solid management team. But projected revenue growth is only about 7%. It's stable, predictable, linear growth. Nothing wrong with that, but it just doesn't have that compounding acceleration needed to be in the UHG conversation.
Got it. And one last quick mention, SoFi Technologies, the digital bank. Explosive member growth, 8.7 million, up to almost 11.7 million in just a year.
Yeah, SoFi is playing the long game. It's a lifetime value strategy. Spend big now to acquire customers, build the tech platform, and then make the real profit later by cross-selling higher margin products, loans, investing, insurance to that massive user base.
And there's a bullish kicker related to the economy, isn't there?
Right. They're achieving all this rapid customer growth despite arguably the toughest environment for lending in maybe 15 years because of these high interest rates. So the thinking is when the economy eventually turns, when rates normalize, that could act like rocket fuel for SoFi's lending business, a potential hidden accelerator.
This has been a fantastic tour through different sectors, all looking for that UHG DNA. The core lesson seems pretty clear. Genuine ultra-high growth comes from that sustained, massive revenue expansion. But, and it's a big but, it always comes packaged with that extreme volatility that really, really tests your belief in the story.
Exactly. Go back to the F1 car, that expensive price tag today. It only makes sense if the company executes almost perfectly, if that revenue growth eventually translates into massive earnings growth. But when they do pull it off, the returns can be truly unique, unlike almost anything else in the market.
So thinking about Meta's comeback, this giant that people kind of wrote off, makes you wonder, what traditionally boring sector, maybe infrastructure, maybe ag tech, maybe some essential industrial supplier might be hiding the next UHG stock? You know, that rare bird with sustained 20% plus growth potential, but maybe flying under the radar right now, ready to become the market's next unexpected F1 car. Definitely something for you to think about until our next deep dive.